Yes, sir. XYC Digital Solutions Limited is a technology company based in India, and it's planning an IPO with a price band set between 400 and 500 rupees per share.
Now, this company is basically XYZ Digital Solutions. So it is an IT company. So it is coming with an IPO in India. So it has set a price band. Okay, a price band of 400 to 500. Okay. Now we all know that the higher upper limit of the price band is 20% of the lower band, or 120% of the lower band. So it was 500. Okay. Uh, I mean, is it meeting the criteria? Anyway, so we'll just look at it. It's planning an IPO with a price band uh, between 400 to 500 per share. Okay, and second,
The company plans to list its shares on both the National Stock Exchange and Bombay Stock Exchange.
okay, now in this case, Adi, what I had observed is that the upper band should be 20% more than the lower band, but it is just crossing it. Okay, so that's correction we need to make. Okay, fine, it should be 480, not 500. Okay, now this company is coming with a price book built issue. That means, okay, so it's going to ask people to bid for the IPO, a price between 400 to 500, which is mentioned here wrongly. So they are going to make a bids for that, and the company is going to decide at what price they are going to issue the shares. Okay, their company plans to list its shares both in the National Stock Exchange and Bombay Stock Exchange. Okay.
Here's how we can interpret and calculate relevant financial ratios and the basis of issue price.
Now, there's a very important section of the prospectus, or red herring prospectus, because it is called, because at the time when the price band is given and not the price, so till the time we don't call it prospectus, we call it red herring prospectus. Okay. Once the company decides the number of shares as well as the price, then it is converted as into prospectus. Before that, it is called a red herring prospectus. Okay. And then a company has to give a justification in their prospectus or red herring prospectus, what is the basis of issue price, how they have fixed up this price between 400 to 500. Now the share price may be face value may be just 10 rupees, but they are offering at a premium of 390 or 490 per share. So they have to give a justification that why they are charging such a hefty premium, and they have to disclose some of the financial ratios of the historical financial ratios based on their whatever business they have done in the past. Okay.
Let's assume XYC Digital Solutions Limited has the following financial data. Net profit 100 crores, total outstanding shares 10 crores, shareholders equity 500 crores, and total debt 150 crores.
So this is some of the information which has been given. Company has made a profit of 100 crores, okay, last year, and the total outstanding shares, that means total number of shares which company has in the balance sheet, is 10 crores, okay, in the numbers, okay. So these are the number of shares which company has is outstanding as of date. Shareholders equity is 500 crores, and total debt is 150 crores, okay. Okay.
Step 2. Calculating financial ratios for upper and lower price bands. 1. Earnings per share. EPS equals net profit divided by total outstanding shares. So here will be 100 crores divided by 10 crores, which will give us 10 rupees per share.
So that means company's earning per share, it is very, very important number for the shareholders. Whether you want to buy a company from a stock exchange or apply for an IPO, you look at how much company is earning, because the EPS will belong to the shareholder. Okay, because the company is going to declare a dividend. If the company earns a profit on every share, then company may say, okay, we are going to declare a dividend of 20%. So that means they will give 2 rupees to the shareholder as dividend and retain 8 rupees into the company's business, and that 8 rupees which they have retained will be go into the free reserves of the company. Okay, as I showed you yesterday, that what are the free reserves. The free reserves are created out of the retained profits what the company has earned and not declared as dividend. Okay, now that retained profits will be deployed into business for buying future buildings, equipments, and investments which are needed to expand the business of the company. Okay, so this will be reflected in the balance sheet on the asset side, and that 8 rupees will go into the free reserves. Okay, so this company has earned a 10 rupees EPS. Okay, in the current year, and now we have to look whether this company is good or bad compared to what it has done in past and what it will do in future. Suppose the EPS keeps rising, that means the earning per share is going up, the company is good, and the investors will put money into this company in future also. So this is a very important number from the shareholders perspective. So if the company pays dividend and retains the money and expands further their business, the share price in the market will go up. So a person will get a capital appreciation while he holds the shares, and also get some kind of a recurring income in form of dividend. So whenever you invest your money in a company, you get two kinds of income. One is called the recurring income, another is called the capital appreciation. The capital appreciation is because the share price goes up, because the company is doing business, and it is the EPS is growing, and they are keep plowing back the money into the business out of the EPS what they earn. Okay, so any company which declares 100% dividend will not have anything to grow, but the share price will the earnings will be coming only through the recurring income, which will be the 100% of the dividend which the company has earned as a EPS. Okay, fine. So then again, next.
Price to earnings ratio. At the lower end, you'll have 400 rupees. So price per share will be 400 by 10, which will give us 40. At the upper end, we'll have 500. Then the price per share will be 50 rupees.
So that means the price earning ratio here, which the company has given on both, the upper band as well as the lower band, which will be basically the share price divided by earning per share. So that means if if people apply between this two bands, the price earning ratio would be around between 40 to 50. So it will be on average say 45. So now whether it is high or low, it will depend upon when you compare with the industry. At what P multiple the industry is trading. Okay, let's look at the second slide so it will get clarified.
PE ratio. The PE ratio tells investors how much they are paying for each rupee of earnings. A higher PE suggests higher growth expectations or premium valuation, while a lower PE may indicate undervaluation.
So if it's a higher P ratio, that means company is trading at a premium. Okay, or the company is expected to grow in future. Normally those companies will command a higher P ratio, because if their prospects are very good, so people are keep buying those shares at whatever price they are available, and the P ratio will also go up. Fine, because it is basically it's the price, the market price divided by EPS. So you keep the share price keep buying, keep increasing, so the P ratio will also keep growing. So only those companies P ratio will be higher if those companies has a great future. Okay, because they expect their earning per share to grow in future. But in case of the companies where P ratio is higher, but the expected growth is not there, so that means we'll say the company is overvalued. So a higher P ratio for those companies which don't have a growth potential, we say that this P ratio is very high. So if you find across a company whose P ratio is very high, suppose in respect to an IPO, so we'll say that this company is not worth investing. But if the company is premium, trading at a premium valuation, and you expect the company's profits to grow in future, then the PE ratio may be at premium, but still the IPO may be attractive. Okay. Now, if the P ratio is low, so we say it's undervalued company. Okay. Whether it is undervalued because people don't know about this company and company may have good future, so it is worth buying, or the company deserves a low P ratio because the business is not so good, so people don't buy it, so it will command a lower P ratio. The P ratio is a very important ratio. Okay, before the you put money into any stock or an IPO. Okay, so we'll further get clarification as we move along. Okay, second, third.
Return on equity. Return on equity can be calculated by dividing net profit by shareholders' equity. So the ROE here is 100 crores divided by 500 crores, which gives us 20%.
So which means the ROE is very good. The company's net profit is 100 crores and company's share capital is 500 crores. So that means the company is earning 20% return. So if you put your money in any place and you get 20% return per annum, so you will be thrilled, okay? Because if you put in an FD, you get just 7%, okay? So if your share company is earning 20%, so which means that there is a likelihood that you will get a capital appreciation, or dividend plus the capital equivalent to 20%. So you would like to put your money into such kind of a company whose ROE is above say 15% or say 20%, or maybe but any company which is less than 10%, you will not even touch that company, because you will not, because investing in equity is risky. So why should you put your money if the ROE is just say sub 10%? You can always put your money in a fixed deposit and absolutely be earning about 7 to 8% kind of a return without taking any risk. So a 20% ROE means that it may translate into a 20% return on your investment if the share price also match the ROE growth. So you would like to put your money, because here look, the return on equity looks to be very good. Just read this. Nirdi?
20% ROE indicates that XYC Digital Solutions Limited generates 20 rupees of profit for every 100 rupees of shareholders' equity, reflecting efficient use of shareholder funds.
So that means they're efficiently utilizing the money which has been given by the investors or the shareholders and generating a 20% return for themselves, for the company, and then it may generate the same kind of a return for the shareholders. So 20% return is very good. So if you find a 20% ROE and you expect this growth ROE to remain either 20% or more, then you should be always putting your money in such kind of an IPO. Okay.
Debt to equity ratio. The debt to equity ratio can be calculated by dividing total debt by shareholders' equity. So here the debt to equity ratio is 150 crores divided by 500 crores, which gives us 0.3.
Okay. Now, here a debt equity ratio, if it is as low as possible, it is good, because that the company is not relying more on debt, it is relying only on equity. So company is not becoming very risky. But of course, you require debt also to grow. Okay. Here you find the debt is 150 crores and equity is 500. So that means company is running on its own money more. It's like 30 paisa per 1 rupee, which Reliance is on debt, and 1 rupee is on equity. Okay. So the company, this ratio looks to be very good. If it is 0.2, 0.1 or 0, it is still better. Okay. But not all the time it is better, because the company may find that the debt is required for all the companies, because to grow further, to expand, they require to put a lot of money in assets. So all the growing companies which have great capital needs, like Reliance or other companies, they would like to borrow more and money. Okay, fine.
A debt to equity ratio of 0.3 indicates moderate leverage, implying that the company has relatively low reliance on debt financing, which could be favorable for investors.
So if a company has a low debt to equity ratio like zero point 0.3, that means it is not so heavily leveraged, and it may be good for the investors, because the company doesn't have a risk of bankruptcy. Because if the company is not earning, but the debt needs to be serviced, you need to pay interest on whatever loans you have taken. So if the company is not earning, then there is always a risk of bankruptcy. Okay. So here, the investors will note that for this company, that debt is not great, because they have that to equity ratio is just 0.3.
These ratios provide a quantitative basis for evaluating the investment, and they will be computed at both the upper and lower ends of the price band as per regulatory requirements.
Requirements. Okay. So these ratios are very important, what we have discussed, okay, so far. So basis for issue price. Now this is a very important section in prospectus of a company. So we'll see a prospectus later on. Just look at and read this.
The basis of issue price section in XYC Digital Solutions Limited's offer document will include the justification for setting the IPO price band between 400 and 500 rupees. This price range is based on several factors.
So basically, in every company's prospectus or offer document, they have to give a section, particularly a paragraph in that offer document, which will be called basis of issue price, where they will, give why they have chosen the price between 400 to 500. Okay, so what has led this kind of a price band? So they will give a full justification so that investors know about it and before they put money. Okay, fine, just read this.
Industry benchmarking. The average PE ratio for the Indian technology sector is around 45. Setting XYZ's PE between 40 and 50, lower and upper respectively, aligns it with industry standards and reflects the company's growth potential.
So here we find, then the company has to give what is the industry's, they have to, benchmark against the industry. And, they have to tell, how the company is, benchmarked against its peers. That means in the same industry, like an IT company, all the IT companies in India, at what P ratio they are trading on an average. Okay. Suppose in this case, this company is trading at the industry average is 45. So at setting a P ratio between 40 and 50 reflects the company's growth potential, that the company's been around the same average. So it is not expensive compared to the industry, because the industry itself is trading at a 45 P ratio, and here it may be somewhere between 40 and 50, upper band and lower band. Hopefully it should be around 45, so that means it will be trading at a almost the multiple which the industry is trading. So it goes beyond 50, then we say it is expensive. So as per the industry benchmarking, the company is good. Then when we say that the company is is reasonably priced. Okay, fine. Okay, just hold on.
Financial
Just hold on.
performance.
So industry benchmarking. So I'm just going to share you. Today in the morning, what I did was that I just got this P ratio. I'm just going to show you that. Now, if you look at, are you able to see this Word file?
Yes, sir.
So if in the morning I looked at at what price earning the Indian stocks are trading today, like Nifty 50, which is an index of India 50 stocks. So they are trading at a P multiple of 23, okay, or 22.9, and Sensex is trading at 23.2. So this is basically a all industry average. Okay. Now from this point of view, it looks that the P ratio of IT industry, which is 45, is trading at a premium compared to both Nifty as well as Sensex. If suppose it was an Indian company, okay, which example which I've shared. So, but we don't compare with the market. We just compare with the industry. Okay. Now then I looked at how it compares with other countries of the world. Okay, like suppose, is it India expensive compared to the world? When we look at the P ratio based on the index. Okay, like United States, it's trading at 26.45 P ratio, which is expensive. Okay, the evaluation that is expensive because I mean, maybe that it has been trading at a lower P multiple earlier, and now it has become very expensive. India is also a very expensive market. It's trading at a P multiple about 25.8 here. Australia is trading at 20.57. Canada is also very expensive, 18.67, and France is trading at 17. So all the companies which are trading at a very low P ratio, like Japan, is trading at 12. So, which is the most expensive, country in the world in terms of share market, which is trading at a very high prices, and which is the lowest one? Anyone? Ananya, Balaji.
USA is very expensive.
USA is the most expensive market. Okay, so USA is the most expensive, and Ananya, which is the cheapest market in the world?
As per the data, Brazil, but it is not undervalued.
It is fair.
It's
We
fair
say
to pay.
it's fair, but undervalued Japan. Okay, fine. Though Brazil is trading at low P ratio, but it is fair valuation. Okay, because the valuation, the P ratio, how we say it's fair or expensive compared to what has been the historical average. Okay, if it is trading, and if suppose the country is growing, okay, if the growth rate is very good, then we say that though it may be trading at a at a high P ratio, but the growth will take care of the P ratio, because the next year it will fall down. Okay, if the company keeps growing, if the EPS keeps growing, that means if the denominator is increasing, it will push down the P ratio, and the stock may not look to be very expensive, or the market may not look to be very expensive. Okay, so here Brazil and China, though they have a low P ratio, but still they are classified as fair, whereas Japan, which is undervalued, maybe that it has a great, good potential to grow, but the growth rates expected in future is good, but it is trading at a low P multiple. So out of all these market, which market you should be putting your money in? If suppose you have to make a choice and you can put money in any market, which is the market would be putting your money? Anyone?
The ones that are evaluated as fair.
No, it will be basically the indicator should be undervalued. So Japan looks to be the most best market today. I mean, based on this, in this kind of data, what we are seeing, that though Japan is trading at just 12.2, almost like half the Indian market, okay, and it is undervalued. So which means that Japan may has a good growth prospects in future. That's why it has been classified as undervalued. So it is the shares are not trading very high. It is basically the market price per share divided by the EPS. So that means the share prices are not very high because the EPS may likely to be grow in future. So which will push down the P ratio further. So it's better that you invest now. Okay, so people may be investing in these markets. Okay, we'll look at the little later about this. Okay. Okay, so fine. So I'm just going to go back to my slide. So can you just read this? Can slide is visible? Nidhi?
Yes, sir.
Okay. So okay, now again, just to take you to for example, just to take you to the a screener, okay, and see uh, the other industries, okay. For example, let's say IT, let's say Infosys, okay, Infosys, fine. Infosys and just look at the peer, okay, group. So these are all the IT companies in India, okay. And what is the median P ratio here? Nidhi, Ananya?
So 27.13 for Infosys.
No, what is the median? Are you able to see the screen
Mm,
on your thing?
yes, sir. Sorry, yes, sir.
So if you
Network.
just read this, okay, read this. What is this?
That's a median of 34.34.
34, okay. So that means the median is 34 or the average is 34, okay. Always the median is always better to look at rather than the average, okay. So the median is 34 and TCS is trading at a P multiple of 29.93, okay. So which is the most expensive company compared to the average industry average? Persistent systems, okay.
India, sir.
Yeah, yeah. Ananya? So which is the
So
company, yeah, which is the most expensive company?
persistences.
And which is the second most expensive company?
Tech Mahindra.
Which is the cheapest of the IT lot?
Wipro.
Wipro. Now, Wipro is cheaper, okay, but it doesn't mean the company is worth investing. It is today undervalued compared to the industry median, but it may not have good growth prospects. Okay, that is what we have understood, because if you just go through the Wipro's, look at the Wipro's, profit loss account, for example, and look at, its earning per share. Okay, so look at the earning per share, it's growing. Yes, it is growing 22, 23, 26, 29, 31, 38, 45, 52, 58, 63. It's growing. Okay, fine, it is growing, but it is not growing at a blistering pace as compared to, for example, say, let's look at, a TCS, for example. Okay, so TCS, if you look at its profit loss account, then you find that the earning per share is growing, it's going from say 126, 131, 115, 104, 87. So you may find that the company is growing at a good pace. Okay, of course, this was a stagnant period of the company's growth phase, and this was the time when the company started growing again. Okay, fine. So we have to look at how the earning per share of the company is growing. So then only we can say whether the company is, expensive or whether the company is cheap. Okay. So let's go again to this. Okay, so let's go to say, for example, say the Asian Paints or paint industry, and then you answer me the questions. Okay, look at Asian Paints. Okay, look at the paint industry. So all these paint companies are there. Asian Paints, Berger Paints, Nerolac, Asgo Nabel, Indigo Paints, Shalima Paints, and another company. So now, what is the median P ratio?
50.41.
50.41. Okay. Now, which company, according to you, looks to be the most expensive?
Asian Paints.
Yeah, Asian Paints and maybe Indigo Paints, they are almost having identical
Yeah,
P ratios. Okay.
yeah.
Though they are expensive, but they are going at a very good growth. Their earning per shares are galloping. So people are buying them and pushing up their P ratios. Okay. And which company has the lowest P ratio?
Nerolac.
Nerolac, yeah.
Now you have to examine if Narrowlack is not growing. Okay, like if you look at the quarterly profit log on, so there are some negatives out here. Okay, so basically all the companies in the paint industry has shown a negative growth. Okay, fine, and sales growth is also negative. Like even Asian Paint has not grown. Okay, only Berger Paints have grown by 2%, and Noble has grown. So you have to examine further that if the company is today trading at a very low P ratio, but how does it look? How the growth looks to be in future? If the growth is good, then you should buy Nerolac. If you expect the growth is not there, the share price is not going to grow because the profit growth is not be there in the coming years, or the company doesn't have a great future, so it will always be trading at a lower P ratio. But if it is trading at a lower P ratio, but it has a great growth prospects, then the share is undervalued. But normally all these companies are available, I mean their information is available in the public domain, and people have well researched these companies. So if you go by that analysis, then this company seems to be trading at a low P ratio because it doesn't have the growth prospects. When we are looking at this peer group, because these are the companies which are big companies of India. Okay, and these are well researched companies, and people only the companies which are having higher P ratios, they look to be expensive, but there is a great future of these companies. Okay, so you can just examine.
So I have a doubt here.
Huh?
So like Nerolac has the lowest PE ratio here,
Yeah.
but its market cap is pretty high. So how
Market
do
cap
we
is how much?
exactly
Market
value it?
cap is 23. This one you're saying, is it?
Yeah,
7.
it's higher than Noble, which has a higher PE ratio though.
Higher than Noble
Indigo
and
Paints
P ratio.
also.
So the
Yeah.
market cap doesn't mean, okay. So we can just look at, for example, we may look at, for example, say Narrowlack, okay, and look at what is, you have to look at from not only the market cap perspective, but you have to look at the potential with respect to the EPS also. Now EPS is how much? The EPS is growing, isn't? So the
E-
EPS is, for example, if we look at the EPS, so EPS of this company was 5, and it is going to 14.66, but it is going to fall further. So it is falling further in the trailing 12 months. Okay,
yeah.
fine. Maybe that first half year figures was less.
Uh,
So here the chances of this company doing well is great, because the company, though the company was trading at a, if you look at the EPS here, it was 6, then it fell down to 4. So there was and then it went to 14.66. So we may have to look at the reason why this company has shown a very high earning per share here, like whether it is
okay.
because of some other income. Look at some other income here, 753.
Okay.
Okay, if you look at here other income, the other income is coming from non-operating, that not from selling their products. It is because they have sold some kind
Right.
of asset and realized some good money, so that has pushed up its earning per share in this year. So this is just an aberration, so it is not going to means that there is a high growth prospects. So they have realized some money because of other income other than running the business. Okay, so if you can just even look at like exceptional
Okay.
items, 703 crores. So this is something exceptional
Oh,
income which the company has got. So this may not repeat because if you look at the exceptional income in the past, it was only in 2016 which we got 542 crores, and then there was a period of complete blackout. They never earned this
no.
income. So this is a very not non-recurring phenomena. Okay, so
Okay.
this may not lead to that the equity, the P ratio to become higher so that people get attracted to this company. Okay, fine.
Yes, sir, that makes sense.
Okay, so of course this is we have to go through so many things. It's not very simple. Okay, but I just explained you because we luckily we got that the company's EPS has grown because of the exceptional income. So otherwise you have to drill down a lot to really understand. Okay, so just read
Okay.
this narrative.
Yes, sir. Um, Industry benchmarking. The average PE ratio for the Indian technology sector is around 45. Setting XYZ's PE between 40 and 50 aligns it with industry standards and reflects the company's growth potential.
Okay, now one thing here, though when we look at the Nifty and Sensex, their P ratio was close to about 25 or 23, and some industries they command a higher P ratio compared to the Sensex or Nifty. Some companies or industries they are trading at a low P ratio compared to the Sensex. That's why Sensex is just an average. So normally an IT companies they always trade at a premium compared to the Sensex. So they will always have a higher P ratios. So here the P ratio was when we look at the real data, the median P ratio is around 34 when you look at the screener. Of course, this is an hypothetical example. He's saying the technology sector is trading at 45. Okay, so even the paint industries like FMCG companies have a great potential to grow. So they will always be trading at a higher P multiples compared to the Sensex. Okay, and for example, if you look at the steel companies, okay, like for example, let's go back and look at companies like steel companies here. Okay, so they will be not commanding that much of higher this thing. Look at Tata Steel example. Okay, and look at how their peers are trading. Okay, so look at the P ratios of Tata Steel is very high because of some reason, because the company's median is only 21. So maybe the company's high, we have to examine why it is high, but otherwise normally it trades at a P multiple of just 5 or 6. Okay, but this is not the data needs to be examined. That's why I'm just pushing it down again. Okay. Okay, so read further.
Financial performance and growth potential. XYZ Digital Solutions Limited has a high ROE of 20%, which is above the industry average of 15%. This demonstrates strong profitability and efficient capital utilization, justifying a premium pricing.
So now first we look at the P ratio. So we found that the P ratio was almost in line with the industry. So this company looks to be good. It's not quite overvalued in terms of the IPO price. So we can say okay. So you keep giving some marks on the basis of P ratio or the valuation of the company, and this is the most important one. Okay. The second one was the financial performance and the growth potential. So currently it is giving 20% ROE, and the industry is generating a return of 15%. Okay, so that means here also the company is doing very well compared to the industry. So if you find such kind of an company, you should be putting money in, and if it is very expensive, then you should keep away. If the P ratio would have been here 80, okay, then even if the high ROE would not induce you to invest in this company, but here the P ratio is in line with the industry. So but the ROE is greater than the industry. Okay, so you should be putting your money. Now just tell me, Nirdi, looking at the two aspects, one is the ROE and the P ratio, does this company XYZ is a really good company to put money or not? Why?
So the ROE here is 20%, which I think is a good
ROE is
benchmark
20,
for
but then
profitability.
just elaborate it further and why it is good.
Because the average is also 15%, so it's a 5% higher than the industry average.
Yeah.
That's one. And the PE ratio is set at 45. Sorry, the Indian technology sectors is at 45, and it's this XYZ's price band is between 40 and 50, which is around that same average.
Okay.
So I think it's a good company to put it in, considering only these two
So
factors.
in terms of valuation, this company doesn't seems to be very expensive. It looks to be in line with the industry, but in terms of profit, the ROE, perspective, it looks to be a better company compared to the industry because this company is giving 20% return compared to the average return which the industry is offering, which is 15%. Is that okay to all of you? Ananya, Janardhan?
Yes, sir.
Janardhan, have you understood? Sophia? Natasha, are you there? Where everybody's gone? Okay. So, Ananya, are you there? Am I audible?
Yes.
Okay. Fine. So let me just look at, because there were some lot of students who were there. So I'm just finding that they are not responding. So just let me look who is there. So Nirti is there. Janardhan, are you there? Ananya, are you there?
Yes, sir.
Sana, are you there? So Arjun, you are there?
Yes, sir.
Okay, tell me, Arjun, looking at these two boxes based on the industry benchmarking and the financial performance of the company XYZ, would you like to put your money in this in IPO? If they come out there is a real case, then would you be putting your money and why? No idea?
No, sir.
So सुन क्यों नहीं रहे हो? You will be going to watch a video later on, or you are not listening?
Going to watch a video.
Please listen, okay? Fine. So Nirti is going to tell you. Just listen to Nirti what she says. Nirti, just tell Arjun
Yes.
why this is this company good or bad?
It's a good. It's a
Why it is
good place
good?
to
Just in
work.
short, one line, say that why it is good.
Because there are two factors to consider. One is the PE ratio, and the industry PE ratio is 45, and this company is set between 40 and 50, which aligns with the industry growth potential. That's one. And the second thing is the ROE, which is return on equity. So the industry average here is 15%, but this company's is 20%, which is a solid 5% increase from the average. So
No, that's
it shows
20%
good
more than the
profitability.
average. Yeah, definitely increase or more. Okay. So it is in terms of valuation, the company looks to be in line with the industry, and in terms of the return on investment, it is giving 20%. Okay, which is a great return, Arjun. If you're getting 20% return by putting your money in any company, you should be very much interested in putting your money instead of just sitting at home and doing nothing and investing in a fixed deposit. You should be putting your money in this company. Is that okay, Arjun?
Yes, sir.
अब तुमने तो सुनते हो हमेशा तो प्लीज रिप्लाई ओके जस्ट लिसन टू मी आई एम गोइंग टू आस्क यू मोर क्वेश्चन ओके
Okay, sir.
ओके अर्जुन प्लीज रीड नाउ फर्दर
Sir, I am watching this on phone, so I can't see that the
ओके
screen is.
सो नीड दी कंटिन्यू प्लीज
Yeah, sure. Market conditions and demand projections. With India's rapid digitalization and increasing demand for technology solutions, XYC Digital Solutions Limited is well positioned for growth. The IPO price band is set to attract investors by aligning with these favorable market conditions.
So they say that because there is a rapid digitalization in India and increasing demand for technology solutions, and it is worldwide kind of a phenomena. So this industry is a premium industry, okay, and the company is doing very well in terms of its ROE potential, and it is well positioned in the industry. The IPO price bands is set to attract investors by aligning with these favorable market conditions. So with the if the industry is in such a kind of the company is in such of an industry which is likely to grow, and if the government of India is going to give a lot of incentives through PLI schemes and other schemes they're offering and make in India, so this is going to help the industry and the company. Okay, further.
Risk factors and financial stability. The company's low DE ratio of 0.3 reflects financial stability and low reliance on debt, reducing risk for investors. This stability justifies a higher valuation within the price band.
Okay, now the companies, generally the companies which are basically, less risky, okay, they will always command a higher valuation. That means they will be trading at a higher P multiple. But if the company which is having a very high amount of debt, those companies will be trading at a low P ratio. So the P ratio depends upon two things. Just listen very carefully. The P ratio of any company depends upon two things. One is the risk. The risk comes from the, the debt or the leverage. That means how much loan you have taken. If your debt equity ratio is more than 1, that means if you are relying more on debt, you will command a low P, company will command a low P ratio. The second factor is the lesser and lesser the debt, the P ratio will be more and more. Okay, but subject to the growth prospects. The growth is the most important one. If the company is going to grow in future, that means its earning per share is going to grow, say at rate of 5 or 10, 20%. Then the company will command a higher P ratio. So growth and risk determines the future or the current P ratio of the company. Okay, so they are two very very important. Now Arjun, what are the two factors on which the P ratio will depend upon? I think he's not able to listen. So anybody? Janardhan, are you listening? And what about you? Nirdi, are you there?
Yes, sir, here.
Ananya, okay, Ananya,
Sir,
yeah,
Growth and risk are the factors that determine.
yeah. So yeah, just speak. There was a boy who was speaking. Who was there? Arjun, you came back.
sir, I'm Dhruv. Actually, Janardhan is traveling, so his mic is not working. He
Okay,
told me to.
Dhruv, tell me. Have you? Just talk about this. P ratio. What I said. Do you, have you listened?
Uh, yes, sir.
Can you explain, Dhruv?
So you told that P ratio is mainly determined by two things. That is, the debt to equity ratio, and then the growth of the company.
Okay. So if a company has a great growth prospects, which will whether it will command a higher P ratio or low P ratio?
Higher P ratio, sir.
Okay. If the company has a high debt compared to the other companies, so will this company will have a higher P ratio or low P ratio?
So the company having higher debt will have a lower P ratio.
Very good. Okay. Fine. Ananya, are you there?
Yes, sir.
So the P ratio depends upon two things. What are the those two things?
A risk and debt.
Risk and growth.
Debt.
Risk and
Oh, sir.
growth. Risk and growth. Okay, if
Yeah.
you have to just say in one line, then it is a risk, basically the debt, the leverage, and the growth. Okay, fine. Is that clear? Okay. So is this company good or bad, Ananya? Will you put your money in this company?
Sir, can you repeat?
I'm saying is this company good in terms of the risk factor?
Yes, sir, because its debt to equity is lower than 1, that is 0.3.
Yeah.
So this company has a higher PE.
Okay, so yeah, definitely. So this company will be trading at a higher P/E. Now, if you have to look at whether the company is good in respect of leverage, it is not just 1:1 ratio, which will tell you whether the company has a low debt equity ratio or not. You have to look at the industry. If the industry debt equity ratio is 0, then we can say that this company is actually taking a higher debt. Okay, fine. If the industry debt equity ratio is say 1, then we say that this company is low on debt and less risky. So we have to compare with the industry standard. Of course, we don't have the industry number here, so that's why it will again, debt will depend upon industry to industry. Some industries
So,
require
excuse me, sir.
higher debt. Some industries don't require higher debt. For example, the
Sir, I have
industry
a
in which Reliance is there
question.
requires a higher amount of loans or debts. Okay, fine. Like Adani requires a high debt because it is all into major, telecom or infrastructure products or those kind of projects like solar and other things which require huge amount of money. So the company has to look for debt. But a company like Asian Paints or Hindustan Unilever don't have to take any debt. So it is not, it will depend upon industry to industry. Okay, fine. Just read this, Ananya. Nidhi, can you read?
Yes, sir. Step 3, basis of issue price. This information will be included in the IPO announcement, drawing investors' attention to the basis of issue price section of the offer document for further details. This helps investors understand why XYZ Digital Solutions Limited is valued within the price band and the factors supporting this valuation.
So this information will be included in the IPO announcement, drawing attentions to the basis of issue price. Now, every offer document should contain a basis for issue price, so that the investors can read through and understand how the price has been fixed. Okay, disclosures on stock exchanges and websites. So the company needs to make disclosure of all these ratios on the website. Just read this, Nirdi.
Yes, sir. Disclosure on stock exchange websites. As required, XYC Digital Solutions Limited will disclose these ratios and the basis of issue price on the website of NSE and BSE. The financial ratios such as EPS, PE, ROE, and DE ratio at both the upper and lower ends of the price band will also be pre-filled in the application forms available on these stock exchanges websites. This transparency helps investors make informed decisions about participating in the IPO.
So basically, when you look at the prospectus or a red herring prospectus, all this information will be pre-filled and containing in the information. Like okay. After the summary, I'll just show you that. Okay?
Summary. In this hypothetical example, XYZ Digital Solutions Limited provides detailed information on financial ratios and the basis of issue price to justify its IPO valuation. Investors can assess the financial health and market positioning of the company by reviewing these ratios and understanding the company's approach to setting its price band. The disclosure on the stock exchanges ensure transparency, aiding investors in making informed investment decisions in the IPO.
Okay, so I'll ask everyone to just read this summary in their mind before I move further. I'll just give you 1 minute for that. Okay. Okay, I believe that you have read this summary. Okay, now I'm just going to share you the take-home paper. Okay, so we'll just go to it and understand what is the take-home paper, and then we will have a break. Okay, and then maximum another 45 minutes thereafter the break. Okay, so I'm just sharing the paper, and I'll be this is the take-home paper. No, this is not the take-home paper. So this is the take home paper. What I am doing is I am going to just save it and just share with you. Okay. So this carries 40 marks. So I am just sharing the take home paper on the So this is the paper which I have shared with you. It carries. Okay, so I've got a message from Sana. This is, and I could not respond because I am in a cab on my way to campus. Okay, no issues. Fine. So I'm just going. So this is the take-home paper. Just open the take-home paper on your laptops. Okay. And Nirdi, you are going to read it. Okay. Fine. Just read it.
Okay, so take home objective. This assignment focuses on analyzing the strategic, financial, and operational aspects of a recent initial public offering or follow on public offering in India. Students are expected to evaluate the market positioning, performance, and broader implications of the IPO or the FPO on the company's future and the industry. Instructions: choose a recent IPO or FPO in India within the past 0 to 36 months. Conduct thorough research using reputable sources, financial reports, market analysis, news articles, investor presentations. Third, answer the following questions in detail, providing evidence and critical analysis to support your responses. Fourth, use data, charts, or graphs where necessary to enhance your explanations. The report should be no more than 10 pages, excluding references and appendices. Questions: one is overview and motivation. So in that we have two, which is provide an overview.
Okay. Just hold on.
Sorry, sir, I
Just hold on. Yeah.
think the page. So could you go back to the previous one? Good.
Okay. Just read this. Have you got the page now? Are you able to see the page?
No, so we're in the second question, not the.
No, I've just changed it now. Just wait for a few seconds, it will come.
Yes, I got it. No. So the first one is on overview and motivation. So in that we have two, which is one is provide an overview of the company that launched the IPO and FPO, including its industry, core business, and competitive position. The second one was what was the primary motivation for this company to go public or conduct an FPO? How does this fit into their long-term strategic goals? The second subsection is issue details, which is one is analyze the key details of the IPO or FPO, issue price, issue size, total shares offered, and pricing mechanism, fixed price or book building. So the other one is how did the market react to the initial price band? Discuss any fluctuations or adjustments made pre-listing. And the third subsection is now fund allocation and utilization. So in that we have how does the company intend to utilize the funds raised? Break down the allocation. Sorry, I'm not able to see it. Yeah. Break down the break down the allocation using debt repayment, expansion, R&D, etc. And in your opinion, is the planned allocation aligned with the company's strategic priorities?
Just hold on. This you will find from the prospectus. From the money which they are going to raise, how they are going to put this money. Where they are going to use. Are they going to pay off a loan? How much they are going to money they are going to use for expansion or for doing R&D. Okay. Then you have to say that is it in line with the company's planned strategy. Now again you have to just go to the company's website and look at the investors presentations there. So what is the company's broad company's long-term strategic priorities and what they have set, and is it in line with that? So you have to do.
Sorry, I couldn't get that.
Okay, read further. Fourth.
Okay. Valuation analysis. Evaluate the company's valuation at the time of the IPO and FPO. Use relevant metrics such as price to earnings ratio, price to book ratio, or EV by EBITDA. Yeah. And the other one is how does the valuation compare with its industry peers? Do you find the IPO or FPO fairly valued?
Okay, just hold on. Now, we have done the P ratio today. So next time, when we meet on Saturday, next Saturday, which will be a physical class, so we'll be doing, what is the price book ratio and EV to EBITDA and other multiples, okay? So that you can answer this question while you understand, what are price to book ratio and EV to EBITDA. Okay, fine. Fifth one.
Then we have the market and investor sentiment, which is where we have to examine the market sentiment before and immediately after the IPO and FPO. Were there any notable trends in subscription, QIB, retail, NII categories? And then we have then the other question is analyze the performance of the stock on the first day of listing. How did the perform? How did it perform relative to its expectations?
Okay, now just hold on. The market sentiments, currently the market sentiments are negative because the market is correcting. Okay, so at that time you'll find that people don't come out with an IPO. So whenever the markets are booming and doing well, so all the IPOs and FPOs are around that time when they are placed. But if suppose certain IPO has just come, okay, and suddenly the market sentiment has become bad, so the IPO may not get a very good response. Okay, so you have to just go through what was the market at that time and what was the sentiments and how it favored fared compared to the sentiments. Okay, then competitive landscape. Just read this.
Competitive landscape. Identify and analyze the major competitors of the company in this sector. How does the company position itself in this competitive landscape? The other question is, does the IPO or FPO strengthen the company's competitive position? If so, how?
So basically, then you have to look at who are the competitors. Now, suppose you are an IT company, okay, then your competitors are basically so many. I mean, of course, look at the large caps like Infosys, TCS, Wipro. So all would be your competitors, okay. And if you are going to be a very small company, then you have a smaller company with a smaller market caps. So then you have to find out and what is going to be your product. Okay, so you have to just see that what is the competitive landscape. Is it a very competitive industry and you may find struggle in that industry, or you have some kind of good technology or other kinds of good things so which you can survive in this industry. Risk factors. Okay, read this.
Risk factor and challenges. 1. Identify and discuss key risks mentioned in the IPO or FPO prospectus. How significant are these risks for investors? Second, are there any external risks, regulatory, economic, market driven,
So
that could impact
sure. Keep reading.
that could impact the company's performance post IPO?
So the risk factors and challenges, you will find this information available in the prospectus itself. So I'll just show you a prospectus. You will find all the risk factors have been listed by the company itself in their offer document. So you don't have to go anywhere. All this information is available readily in your IPO. Now coming to the eighth factor, I'm just going to just skip that for a moment. The ninth, financial performance and growth prospects. So this information will be again given in the prospectus offer document, as well as you can go to the screener. If suppose the IPO came about last year, so you will come to know how the company is performing now compared to at the time when it came in IPO. So what are the future growth prospects? You can always vouch for how the company is done after the IPO has been listed, and at that time you have to just look at what was the company's position. Okay, how much the company was earning. For example, a company like Devyani International, which is basically a franchisee of the Pizza Hut and KFC, it was already an existing company, so it was already performing, and it was declaring the results. Okay, but then it became a public listed company, so all the information is available on the public domain, either on the screener or on the offer document. Okay, so you get impact on industry and market dynamics, so you have to just look that. Okay, additional requirements. So data sources, clearly cite all the data sources used, analysis, quantity, quality, demonstrate critical thinking and use analytical frameworks wherever applicable. Formatting ensures document is well organized and appropriately heading in subheadings, and evaluation criteria will be comprehensive, depth of analysis, relevance and use of data and evidence, structure of and clarity of presentation, and originality in insights and critical thinking. So this is a 40-mark paper. Okay, fine, which I have shown you. So in my next two lectures, so I'm going to give you some how to work on these some of these questions which are mentioned. I'll also share with you last year the best student who has given its take-home paper, which was not on similar lines, but it was still almost the same lines. Okay, so I'll just give you his or her presentation so that you can just go through that. Okay, fine. So now we are just having a small break, and then we will have another last session. We can just continue for another half an hour, and then we can just say okay, or you want a break now?
Sir, can you please continue for half an hour because I have to catch a flight.
Okay, so you're saying I should continue. Okay, so I'll continue. Okay, so another half an hour we are going to close. Okay, fine. So maybe little less than half an hour. Okay, fine. So what I'll be taking you through is in this half an hour is basically a little bit only practical things. So which you will be actually only doing. I'll be just showing you, some kind of public issues which have come in past, like LIC which came. Okay, so this is an old slide at the time as LIC was. So I'll just go to your, WhatsApp this thing where I have shared some of the things. Okay, for example, let's say just open this first one, which is, like for example, we have, so we have some Bector Foods, okay, and LIC and Sula, okay. So which one we should go for? We should go for example, say LIC. Okay, so there are three, IPOs which I had shown it in my past lectures. So I'm just going through. So you can just go to this site chittorgarh.com and you will get a lot of information there. Okay, so if you go through this, so you'll say LIC. Just read this, LIC. Have you opened? So please open. Okay. Nirdi, have you opened?
Yes, I'm just opening.
Okay, just open.
Yes, I opened it.
So, this is, from the LIC IPO basis of allotment. So, this information is available on the website, okay, on a site which is called chittorgarh.com, okay, and it will tell you about IPO details, stock price, and some docs, some reviews, okay. So, Life Insurance Corporation of India, okay, just read this, Nirdi.
Okay, sir. The corporation was established as Life Insurance Corporation of India on September 1, 1956, under the Life Insurance Corporation Act, 1956.
Okay, just hold
For
on.
details of change in the central...
Because, established in 1956, very old company owned by Government of India, okay, and who is the promoter of the company? The President of India acting through the Ministry of Finance, Government of India. So, this is basically a government company and the promoter is always called the President of India, okay. So, okay, just read this. The corporation has filed.
The corporation has filed the prospectus with SEBI and the National Stock Exchange of India Limited and BSE Limited. And the equity shares are proposed to be listed on the stock exchanges and trading to commence on May 17, 2022.
Okay, just hold on. Okay, so what I'm doing is that instead of doing this thing, I think I've just gone to the wrong place. So let me go to say, for example, Bector Foods. Okay, fine. So I think, okay. Just read this, okay? Sorry, we are changing this thing. We are not doing LIC today. LIC will do next time. Just read this.
Okay, so Mrs. Bector's Food IPO is a book built issue of 540.554 crores. The issue is a combination of fresh issue of 40.54 crores and offer for sale of 500 crore rupees.
So, do you all know what is Mrs. Bector? Mrs. Bector is basically a brand name called Cremica. We always eat their biscuits, chocolates and other things. Okay, so whenever we go to a grocery shop, we'll find a lot of products which are available of, Mrs. Bector, which is, they are in the brand name of Cremica. Okay, just go further.
Mrs. Bector's Food IPO bidding started from December 15, 2020 and ended on this December 17th. The allotment for Mrs. Bector's Food IPO was finalized on Tuesday, which is the December 22nd of 2020. The shares got listed on BSE and NSE on 24th of December.
Okay, just hold on. This first of all, this was a book built issue of 540 crores. Okay, and this was a combination of fresh issue of rupees 40 crores and offer for sale of 500 crores. Okay, so what does it mean, Ananya? So how much money will go to the company for future expansion, and how much money will go to the existing investors? Anyone?
So,
Yeah.
offer for sale will be used. The fresh issue 40.54 will be used for further,
Expansion.
and an offer for sale will be used for existing.
That money will go in the pockets of the existing promoters. Maybe it will go to Mrs. Bector's, I mean, this thing, family and all. Okay. So here Mrs. Bector is actually diluting her, shareholdings or the relatives who now own the company. So they are going to, get 540 crores and 40 crores, which is a small portion of the IPO, which will be used for the further growth prospects of the company, and 500 crores will go in the pocket of the promoters. Okay. So what was the price band here, Ananya? Just read the third line. Who was reading? I mean, after Nidhi.
I was, yeah, I was reading, sir.
Just read.
Mrs. Bector's food IPO price band is set at 286 to 288 rupees per share. The minimum lot size for an application is 50 shares. The minimum amount of investment required by retail investors is 14,400 rupees.
So that means the IPO price band has been set between 286 to 288. Now, who sets this price? The company, Mrs. Bector, as well as their merchant bankers. So they will generally form a committee and which will review the company's performance and the future growth prospects, and then they will arrive at at what price the company should offer the shares. Now, the company's share price, the face value would be 10, so that means they are charging a premium of 276 or 286 rupees. It is between 286 to 288. So anything above 10 rupees is the premium that they are charging. Okay, the minimum lot size for the application is 50 shares. So the minimum lot, so anybody who's applying should apply in multiples of 50 shares. Okay, so this is the minimum lot size, and the minimum amount of investment would be 14,400. So if you applied for 15, so at a price of around close to about 286 or somewhere, so you have to pay 14,400. Okay, at the higher upper band, if you just calculate, suppose if I just use a calculator here, okay, just use a calculator, okay, so I'm just getting out of it. So where I have gone, so कहाँ पर था वो? Not here, okay. So I think I was here. So where was Mrs. Bector? Just hold on, I'm just opening Mrs. Bector again. Okay, so I'll just open from the WhatsApp. Mrs. Bector. Okay. So here basically 14,400 is this 50 multiplied by 288. Just do this multiplication, Nirdi. 50 multiplied by 288. How much number you get?
14,400, sir.
So that means, so the minimum investment would be 14,400, which is basically the upper band multiplied by the minimum lot size. Good. So who are the, read further, Nidhi, after this 14,400, what is written? Nidhi, are you there? Ananya, are you there? Who's there?
Yes, sir.
What's your name?
Rajat.
Rachit. Okay, Rachit.
Yes, sir.
आगे पढ़ो. ICICI Securities Limited, यहाँ से पढ़ो. भाई, where are you gone? Ananya, are you there?
Yes, sir.
Sorry, sir.
Okay, can you read after this 14,400?
ICICI Securities Limited, LIFL Securities Limited, and SBI Capital Market Limited are the book running lead managers of the Mrs. Bector Food IPO, while Link in Time Indian Private Limited is the registrar for the issue.
So basically, who are the merchant bankers? ICICI Securities, IIFL Securities, SBI Capital Markets. They are the book running and lead managers of Mrs. Bector's IPO, food IPO. And who is the registrar? Link in Time India Private Limited. So I'll tell you who is the registrar, what is their duties. Okay, so I'll share that immediately after the lecture, and you can just go through what is the job of the registrar and what is his focus whenever the IPO comes. Okay, so fine. So you can always open up this IPO RHP, which is the red herring prospectus. So this is the link to go through the prospectus. So I've shared the prospectus on the WhatsApp. Okay, from here only. Okay. So now, at what was the price? What was the price band, Ananya?
Sir, 286 to 288.
And what is the current price of Bector Foods, which is given here?
Rupees
So is
1890.65.
it done well after the IPO?
Yes, sir.
So the price has gone up from almost like 286 or 288, which is given here. It has moved up to 1890. So any person who has invested in the IPO has made a lot of money. Okay, fine. So if you look at for example last 1 year growth story, so again it has gone up. So everywhere the stock has done very well. It is not trading at 1890. Okay, fine. So look at some more IPO details. Okay, just read this, Ananya. The first box here, left hand side.
IPO date December 15, 2020 to December 17, 2020. Listing date December 24, 2020. Face value rupees 10 per share. Price band rupees 286 to rupees 288 per share. Lot size 50 shares. Total issue shares. Shares aggregating up to rupees 540.54 crore. Fresh issue. Shares aggregating up to rupees 40.54 crore. Offer for sale. Shares of rupees 10 aggregating up to rupees 500 crore. Issue type book built issue IPO. Listing at BSE and NSE.
So again, just to go through this IPO came in 2020. Okay, on December 15th, this is the date, and the IPO opened on 17th December. Okay, 15th December and closed on 17th December. Okay, between 15 to 17, the IPO remained open, and within this days, the whole IPO was oversubscribed, and listing date was 24th December, and the face value per share was 10, and the price band we know was between 286 to 288. Lot size was 50. Total issue size, we don't know how many shares, we don't know what is the price of the share, because the price of the share will be determined only after the bidding. Okay, that's why it's written dot shares, but we know the overall size of the issue, which was 540 crores, and fresh issue was 40 crores, and offer for sale was 500 crores. Okay, and it was a book build, and the share got listed in Bombay Stock Exchange and this thing on the National Stock Exchange. Okay, so tentative schedule. So this is the schedule what is given. Okay, so that means if you look at what is the opening date, okay, and what was the closing date, the basis of allotment will be announced on 22nd. Then the refunds will be initiated on 23rd for any money which was received more than what the company desired. Then the shares will be credited to the investor's account or shareholders account on 23rd December. Listing date will be 24th. Cut-off time for UPI mandate. So if you are applying through UPI, it's 5 p.m. up to 17th of December you can make an application. So this is already happened. Okay, fine. Now see, you can just so we are going to now end and do most of the next time. Okay, so you can just go through my advice would be just go through all these three LIC, Better Food, Surya Vinayards, and this thing. So just go through at home, okay? And next time we will be covering these